In recent years, we've seen central banks accumulating gold at record rates. So there's been talk recently of returning to a gold standard. The question I had was, has there ever really been a gold standard and was it ever successful? We're going to talk about that and more next. Welcome to the program, everyone. My name is Jeff, and we're going to talk about the gold standard and whether it was fact or fallacy. So first, let's dig into the history of money. And when I talk about the history of money, there's one name that comes to mind, and that is Mike Maloney. So I was doing some research, looking at different videos, looking at the past and the history of money throughout the globe. And of course, Mike came up with some great information. So let me share my screen and go over a few clips of one of his videos. This one is about Basel III. That'll be a conversation for another time, but I'm sure that many of you have seen a chart like this, which is the history of the predominant currency across the globe. So you have Portugal, then Spain, then Holland, then France, going back to the 1400s, all the way to the early 1800s. Now, this doesn't mean that this was the dominant currency, then everyone recognized this. What this is that this was the top currency throughout the world because these countries were the top economies. So as they explored the world and they conquered and had colonies and were importers of goods, they had to pay for those goods with their currency. So Portugal and Spain, the doubloons and such, and then Holland and then France with their monetary system. Those were the dominant currency systems around the globe at the time because they were the leading currencies. Then you move on to in the mid 1800s, where the Bank of England established the gold standard. Now, when that happened, the gold standard, it was first started in the 1700s, really, but it became more dominant in the 1800s. And up to the point where in 1871 it was adopted by Germany as well, and that's when it became really the standard across the globe. Later on, the United States entered in the mix in 1913 with the dawn of the dollar, and there was some overlap period too. We'll talk about that on another video as well. But the overwhelming theme that you need to point out and remember, as Mike pointed out, is that for over 5,000 years, gold was the real money and predominant currency asset for 5,000 years. And it was the predominant central bank reserve currency for almost 300 years. So going back to France, again, 1717, with France and Germany and England all adopting to hold gold as the dominant currency. Now, I did a little bit more homework because I like history. I like to dig into things, and I wanted to figure out, how did it come to be? How did the Bank of England become the dominant currency in the 1800s? And was this ever tested? Was there ever a push in the gold standard? Well, as it turns out, yes. And I found a document. It's a very dry document. It's like 90 some pages. It's a reprint of a book, but I highlighted the important pieces, and I'm going to try and go through them and put commentary so you understand what was going on at the time. And a lot of it is going to ring true and sound very familiar. So let me work through that document a little bit, sharing my screen once again. Now, this is a copy of a book that's out of print, but I was able to get a copy of it online. I went through it all. It's rather long, 90-ish pages, a lot of math in there. It's like a research paper, but I highlighted the important parts. First off, the Bank of England, even though established in 1717, formally adopted the gold standard in 1819. And it was going along pretty well, just fine and dandy up until 1847. Now, what happened in 1847? Well, as you digging through this document, you could find a lot of history here. So first off, you see that the events of 1847 were initiated by a major harvest failure in Ireland and England in 1846. The shortage of domestic food supplies led to large price increases and trade deficits, which in turn brought about an external drain of bullion for the Bank of England. So food supply issues, large price increases. Does this sound familiar yet? We move on. Now, the combination of a fresh demand for loans with a curtailment of the capital available for them raised the rate of interest and made it impossible to borrow except on the very best security. So interest rates were going up. Also sounds familiar. Some firms even stopped payment. Their failure involved more or less deeply many other firms which had trusted them. And as usual in such cases, the general distrust commonly called a panic. So this led to the suspension of the Bank Charter Act, or the Peel Act of 1844. I will dig into that a little bit later. So the two major crises happened in the year. First, April with the food shortage, and then they reversed the Bank of England credit policy. So they had their bank and the central bank of their time changed their credit policy. So they got much tighter with their lending. It reversed its policy in April by raising the discount rate, or the interest rate, and only sparingly accommodating the discount market. They didn't make many loans. The suddenness and severity of the action led to a panic, as the best houses in the trade found it impossible to obtain domestic credit. So no one in England could get a loan. Not even the best companies could. Later in the year, the panic in October, by contrast, was due to an internal drain that resulted from a loss of confidence in the convertibility of bank deposits into Bank of England notes. So the people went and looked at their bank deposits, and they wanted to get their cash. They wanted to get their pounds, their paper pounds, or the coins out of the bank, and they couldn't. And that was essentially due to the operation of Peel's Act. So Peel's Act was basically, it enforced the gold standard. Now, there's a lot more in here, a lot of pages of math. I'm going to skip over that and jump further into the document. Digging in further to the two crises that happened in 1847 in England. The harvest failure of 1847 back in April depleted the bullion bank in the fall of 1846 and more in early of 1847. They needed the gold to buy food and import it in because they couldn't find any work and the prices were going up everywhere. So that depleted the bank's gold. Later on, the outgoing decline of bullion tightened credit market conditions and the failure of the bank to change its accommodating stance. They were loaning out money very freely, and in the face of a deteriorating balance sheet, evoked concern about a sudden reversal of policies that leave the public without notes and without loans. So what they did was they changed their lending policy. So they reversed how they were doing. They started to tighten and raise interest rates, similar to what the Federal Reserve did a couple of years ago. During the week of mid-April, April 17th, reserves fell at banks. The reserve deposit ratio, the ratio of deposits on the books compared to how much bullion was in the bank, was down to 20%, which means they only had 20% of the deposits that were on the books was only backed by 20% of the gold. So they couldn't pay everybody if everyone came and created a run on the bank. Now, when the public saw that the whole banking resources were reduced, a panic seized both the public and the directors. During this period, the rate of discount, or the interest rate, for the best bills, best loans, rose to 9, 10, 12%. The severe credit tightening following the April crisis restored the bank's ability to maintain convertibility. They were allowed to, if someone brought in a note, you could get your gold. So they were able to stay okay in April. But the credit tightening that started in April, because the banks were seeing, hey, everybody's coming to get their money, we need to raise our interest rates, raised the cost of credit substantially above what had been in past years, and indeed above anything the public could remember. The rates in 1847 were at a peak relative to the preceding 25 years, which means that the interest rates were the highest they'd seen in a quarter of a century. Now, it's not quite like that in the United States, but the interest rates we're seeing today are the highest we've seen since the global financial crisis in 2007 and 2008, roughly 15, 16 years ago. So it's not too far off. The same point is evident from the reserve deposit ratio that had declined from June of 32% to only 11% in October. So they went from 20%, then they got it back up to 32. Now it's down to 11, which means for every $9 in the books, they only have $1 pound of gold available. So there is a crisis. It's not certain what broke the old lady's back. So even this document, they don't know exactly how this got resolved. The speculation is the following. The bank put up an admirable stone face and would claim in the inquiry that convertibility was never a question. They always claimed, we have plenty of gold. We can convert your notes, no problem. So in 1848, the governor of the bank, James Morris, told the House of Lords. So this is the same as Jerome Powell speaking to Congress. And he said, I always stated that so far as the bank itself was concerned, we had no difficulty. Indeed, the way the bank proposed to restore its financial position suggests that it might well have been able to maintain convertibility by an extraordinary contraction of credit, meaning that they can raise rates and make it very, very hard for people to get loans, so much that people would want to put money back into the bank and they would stop being able to, or even asking for loans. So again, he continued, we should have no difficulty, whatever, in meeting all of our liabilities. Parties came and thought they had only to ask for money and they would have it at once, which was not always the case. So whether the bank might have been successful or not, credit was so severe at the time, at the peak. Commercial failure was so widespread and reached increasingly into the banking system. The government felt it was wise to suspend Peel's Act, which is it was the Act of 1844. So Peel's Act means you need to keep a certain reserve of gold to back up your deposits. That was repealed. So that authorized the bank to issue notes without gold bank backing. This created fiat currency. So by decree, the government, that by decree means exactly what it sounds. Fiat actually means by decree. So by decree in October of 1847, they went off of the gold standard and said, we have plenty of pounds, paper pounds or coinage to give you. Don't worry about your gold. So what later happened, the authorization for fiduciary issue or coinage, paper, currency, coupled with the high discount rate, the high interest rate that the bank was charging, rapidly restored financial stability. So people bought this. They believed this. The removal of the restriction of fiat money issue, which was the Peel Act of 1844, dissipated the concern for the internal convertibility of deposits into notes. No one was worried about converting their paper currency into gold or coinage. High interest rates at the same time brought about very substantial inflows of capital. What that means is that with the banks charging 7, 8, 10, 12% for loans, they were issuing out 7, 8, 9% for deposits. So more people put cash into the banks, which helped their ratios between the bullion and the deposits. So capital inflows, those deposits in turn expanded the bullion in the bank because they took those deposits and they bought more gold. And this led to internal monetary expansion that over time alleviated the extreme tightness in credit markets. By Christmas Eve of 1847, the reserve deposit ratio had risen substantially while interest rates had declined from the peaks of late October. So what we learned here is that the Bank of England, they claimed that when they went on the gold standard in the 1700s, but they really adopted it in 1819, and it was tested in 1847, less than 30 years later. They only survived it by removing the law of 1844, the Peel Act, which tied deposits and their currency to the deposits of gold. So once they got rid of that, with all the pressure, they were able to say, hey, we have plenty of currency, we have plenty of gold, don't worry about it. And the people bought it. And even though they claimed to be on the gold standard from that point forward, and we'll talk about what happened next in a future chapter of this show, people bought into this. So that even though this was basically the creation of fiat currency, because by decree they said we're good, don't worry about it. So the gold standard of the 1800s with the Bank of England, that's allegedly the gold standard of banking at the time, really wasn't a gold standard. It was a gold standard fallacy. So what are your thoughts about this? What do you think about it? Are we heading back to a gold standard? Will we ever have a gold standard? How do we actually get to a true gold standard? I'll explore that and more in future editions of this show. If you have any questions or comments or want to see me explore other topics, please leave a comment below. Like, share, subscribe. Really appreciate that. Really helps with the channel. But until next time, question everything and learn from history, or else we're doomed to repeat it. I will see you soon. Take care.